Welcome back. It's time to answer your portfolio queries, and I'm joined by Harshvardhan Rungta, CFP Rungta Securities. Harsh, good evening and welcome to the show. And let's get connected, Harsh. We have our first viewer, Jagdishwar from Hyderabad, on the phone line with us connected. Jagdishwar, hi, good evening. How are you doing today?
Fine, madam. Thank you.
Thank you so much for sending us your question. As for the details sent by you, you want to know about a few index funds for a short-term horizon, almost 6 months, right?
Yes, ma'am. Yes, ma'am.
Any specific reason you're looking for an index fund? And because the time horizon is only 6 months, ideally you should be putting in this money in a fixed income, which will be explained by our expert later on in the show. But any specific reason you want a recommendation of an index fund?
Yes, madam. Because exit load is not there and expense ratio is minimal like compared to the normal mutual fund, and returns will be after the expected index performance.
You do not want to consider debt fund for this?
No, madam, because the returns are normally low.
Yeah, but then won't 6 months be very risky for you? I mean, you are talking about an equity-linked index fund. So there is going to be volatility because that is what will be mirrored in the index as well. So there is a chance of volatility that might run into your risk also. So you're okay with that?
Yes, madam, that is true.
All right. Harsh, over to you. How would you like to explain him the risk involved and the kind of capital protection that he might get in a debt fund with low returns, maybe?
Yeah, so Kavita, you're absolutely right in guiding Mr. Jagdishwar that if he's planning to invest only for 6 months, then equity funds are not the way to go about it. So your investment is 10,000 rupees lump sum and 5,000 rupees as SIP over 6 months. Now, what I suggest is there are two objectives when you're investing. When you invest for long term, your primary objective is that you should get high returns, good enough to beat inflation comfortably. Then even if there is less liquidity, it's fine. But the objective is in the long term, you should be able to beat inflation handsomely. When you invest for the short term, your primary objective is liquidity with capital safety. And if you get moderate returns on it, great. So which means that it should generate a return which is more than your bank deposit rate or equivalent to your bank deposit rate, at least more than your savings bank account rate. So the objective is that you want liquidity as and when you need it. And secondly, the capital should be safe. That is the primary objective of investing for short term. Now, in case you were to invest into equity mutual funds, over 6 months, over the next 6 months, if the markets were to fall, say for example, though you're investing every month, but you will not be in positive because you've been investing and the markets are going down. And if you need the money after 6 months, you will have to withdraw. There is no choice. So it does not give you the opportunity to stay invested for long term so that you can recover back from an SIP where, because you're doing rupee cost averaging, markets will recover in their cycle. So you will also get an opportunity to come back into positive. So if you're investing for short term, I really suggest that you look at liquid funds, ultra short term funds, or low duration funds. They will not be very high in returns, as you rightly pointed out. But in the short term, liquidity and capital safety is priority. In the long term, higher returns is a priority. So you'll have to figure out the balance between the two and understand the difference rather between the two, and then invest your money. I can suggest one fund for you, which is Mira Asset Ultra Short Duration Fund. Now, this, of course, is a short duration fund, ultra short duration fund, and will not give you equity kind of returns, but you'll be assured that at least you will have some moderate returns that will come to you with adequate capital safety and liquidity as and when you want it.
All right, Jagdishwar, is there anything else? Because see, because it's just 6 months of duration time, it's better if you look at capital protection is what even Harsh suggesting. Is there anything else you want to ask Harsh? Okay, I don't think we have him on the phone line, but then I hope he got the answer and the proper guidance that he needed. Harsh, let's move on and let's take Dr. Pramod Chebi's question. He wants to know that he's saying that if I have ongoing SIP in multiple regular mutual funds for a period of 5 years, is it advisable to shift to same direct funds? And if yes, what is the best way to do it? And Dr. Pramod is not the only viewer over here who wants to shift from regular plans to direct plans. You know, Harsh, we are seeing, and I'm sure because you have a better hand on the ground reality, you must be aware of how investors want to shift from regular to direct plans. The difference in the NAV and obviously return being one of the primary criterias. First, would you recommend someone to do it? And if you're recommending, on what basis one should be doing that?
So, Kavita, direct plans are an option available for savvy investors who can manage their portfolio on their own. So let's understand two scenarios. There is one option, which is a regular plan, which goes through a mutual fund distributor. There is a expense ratio which incorporates the commissions or the brokerages that have been paid to the distributor. In lieu of that income that the distributor earns, there is some guidance given to you in terms of portfolio construction, in terms of servicing issues, in terms of hand-holding, emotional, behavioral biases. Now, on the other hand, there are one set of investors who say that, well, I'm good enough to take care of my investments. I understand the financial markets. I understand investing, etc. I can construct portfolios. I understand the difference between a large cap, mid cap. I know how fund houses function. I can track fund managers, etc. So why do I need to go through a mutual fund distributor? I can go and invest on my own. Now, if you are not taking the services of a distributor, then you're eligible. I mean, why would you then pay a higher rate in terms of the total expense ratio? And why would there be any brokerage or commission involved? So you can go to a direct plan. So the underlying difference between the two things are not only the cost element, but you must see what is the value that you're getting if you're going through a mutual fund distributor. If you don't find any merit in that value, then you go into the direct plan. Now, direct plan obviously will have a lower cost ratio because there are no brokerages to be paid, and hence, over a long period of time, it is understood and believed that you can get higher return, at least to that extent that you're saving in the cost. Now, the process of doing this. So, one is if you're convinced that you can do it on your own, you can manage everything on your own, then go to direct plans. Now, what Dr. Pramod should be doing, he has an existing investment which is going on since 5 years. So he'll have to execute a switch transaction, which means that if he's investing in ABC fund regular plan, he will have to go to ABC fund direct plan. So you'll have to switch from a regular plan into a direct plan. This switch transaction, be mindful, that has a capital gains implication. So it is basically saying that you're redeeming out of one plan and going into the other plan. Though it may be the same scheme, but it has different NAVs. They are two different schemes for all practical purposes. So you will have redemption from a regular plan going into the direct plan. So whatever long-term, short-term capital gains implications are there, you will have to bear that as a one-time expense. The other is the SIPs which you have registered and as a mandate that you've given for your regular plan, you'll have to cancel those mandates so that fresh SIPs will not get hit into the regular plan. And you set up a new SIP mandate onto the direct plan so that your switch has happened and your fresh investments also go into direct plans.
You explained quite in detail, and I'm sure, along with Dr. Chebi, all other viewers who are confused between being in a regular plan or shifting to a direct plan might have got a good takeaway. Let's take Mr. Ampolo Kishore's question, and he says that he's 37 years old with a long-term investment horizon of almost 10 to 15 years. He has a specific goal, saving for his child marriage 20 years from now. He's given you his portfolio details. I will not read out the funds, but then he wants you to advise him on his fund mix, which funds he should be holding, which funds he should exit, and if at all he wants to increase his investments, what should be the fund selection for that.
So, well, Kavita, he's rightly identified that he has about 13 schemes in which he's putting a total of 27,000 rupees as SIPs. So, certainly you don't need that many number of schemes. What I'm going to do is I'm going to pick out 5 schemes from his existing portfolio, and he can invest his entire 27,000 rupees into these schemes. Plus, going further, if he has any further investments to make, there's ample room to use the same schemes to add up your SIPs. So he retains the ICICI Pru Blue Chip Fund in which he puts 5,000. UTI Nifty 500 Value 50 Fund 5,000. Motilal Oswal Mid Cap Fund 5,000. Nippon India Small Cap Fund 5,000. SBI Gold ETF, he can increase the amount to 7,000. I also recommend that he continues with his PPF. He is putting about 500 rupees per month. In case he wishes to increase that amount, he can proportionately reduce that amount from an SBI Gold ETF. So if he wants to increase the SIP or rather the investment into PPF from 500 to say 2000, then he should reduce the SBI gold fund by 1,500 rupees. So just correspondingly, just switch, make that balance. Further going, if he has any more investments to make, increase his SIPs, these five schemes are good enough.
Let's move on and let's take Sunil Singh's question now. Harsh, that's the last question for the show. And he says that he's 45 years old, been investing in a couple of funds, and he wants your expert advice in order to understand whether he should be discontinuing any of these fund mix. And he's got certain financial goals aligned. For a few years. I think there's a 7 years goal that I can read in his portfolio. His time horizon is only 7 years. So yeah, what would you like to recommend?
Yeah, so again, the case being that 19,000 rupees investing every month has nine schemes not required. I can reduce it to four schemes so that it becomes easier for him to manage and track it going further. Again, I'm picking up four schemes from his existing portfolio. So, which is HDFC Top 100, puts a 7,000 rupees in that. Motilal Oswal Mid Cap Fund invest 5,000. Quant Value Fund 5,000. Nippon India ELSS Fund 2,000. So, ELSS is the same amount which he's already investing because maybe he's aligned that towards his ATC requirements. Of course, redeem out of all other funds and consolidate them only into these three schemes, excluding the ELSS, of course. Keep it only into the three schemes: HDFC Top 100, Motilal Oswal Mid Cap Fund, and Quant Value Fund. Now, one point I want to highlight here: he needs the money after 7 years. So, 5 years from now, start moving money into debt gradually because he needs the money in 7 years. So, don't wait for the last day of into equities. If the markets get volatile, you might just have a lot of volatility in your portfolio. Rather, 2 years prior to when you need the money, start moving it from equity to debt gradually.
Harsh, I think with that we are done with the viewer queries also on the show. But thank you so much for taking time out and answering our viewers' portfolio queries live on the show. Thank you. And for all the viewers, I'm going to leave you with our WhatsApp number and email ID. So just in case you want to send across your investment, insurance, credit card, loan, or any specific financial strategy related questions, you can do that on our WhatsApp number and email ID. Thank you so much for watching. Goodbye.